When you look at the financial world in 2025, one acronym keeps popping up everywhere: ESG. It's short for environmental, social, and governance, and it has become one of the most powerful forces reshaping how capital flows. If you're wondering why some of the biggest banks, asset managers, and corporations are suddenly obsessed with carbon footprints, inclusivity, and corporate transparency, the answer is simple: ESG has gone from being a nice-to-have to a non-negotiable standard. Now, I know what you might be thinking: ESG can sometimes sound like a buzzword thrown around at conferences. But let's strip away the jargon. At its core, ESG is about holding organizations accountable. Are they polluting the environment or actively reducing their impact? Are they treating people fairly, from employees to customers to communities? Are they running their operations transparently, with checks and balances that build trust? Those three pillars, environmental, social, and governance, are now directly tied to money. In fact, ESG assets under management worldwide are expected to top $50 trillion by 2030, representing more than 1/3 of all global assets. That's not just a side trend, that's the financial mainstream. And here's the twist. Blockchain and crypto can't afford to ignore this. Why? Because institutions are under pressure from shareholders, regulators, and customers to ensure their financial operations align with ESG goals. A pension fund in Europe, for instance, can't just throw money into any blockchain project. It needs to prove that its investments don't contradict its sustainability commitments. A payments company in Asia can't scale a new service if regulators decide its technology partners are environmentally harmful. ESG is the filter through which decisions are being made. That's why the sustainability narrative has become so critical in crypto. For years, Bitcoin has been criticized for its energy consumption. Whether you agree with those criticisms or not, they've stuck in the public imagination. Ethereum felt the heat too, which is why its 2022 switch from proof-of-work to proof-of-stake was framed as a massive ESG win. It cut energy use by over 99%. And this is where Hedera steps into the conversation. Because unlike Bitcoin or even Ethereum post-merge, Hedera didn't have to retrofit sustainability. It was designed for it from the start. Before we dive deep into Hedera's angle, let's zoom out a little more. ESG isn't just about being green. It's also about resilience and long-term value. Investors who care about ESG aren't doing charity. They're betting that companies and technologies aligned with sustainability will outperform in the long run. Think about it. A blockchain that guzzles electricity and attracts regulatory crackdowns has higher risks. A blockchain that runs efficiently, complies with global climate goals, and offers transparency? That's a safer, more attractive bet. And there's another layer: public perception. Consumers today are more conscious than ever. If two fintech apps offer the same service but one can show it runs on a carbon-neutral network, that becomes a competitive edge. ESG isn't just about back-end compliance. It's becoming a brand advantage. So, where does this leave the crypto industry in 2025? Well, we've hit a fork in the road. On one side, you have networks that are still fighting off criticism about their carbon impact. On the other, you have networks that see ESG as an opportunity to differentiate themselves. And sitting right at the intersection of that opportunity is Hedera. HBAR's ESG positioning isn't an afterthought. It's its secret weapon. When financial institutions evaluate blockchains for tokenization, payments, or supply chain tracking, they aren't just asking, can it scale? They're also asking, does this align with our ESG commitments? And increasingly, Hedera is one of the few that can confidently say yes. To really appreciate why this matters, think about the broader ESG wave hitting every industry. Automakers aren't just judged on how fast their cars go. They're judged on whether their supply chains are clean and their fleets are electric. Food companies aren't just selling taste. They're selling transparency about sourcing and fair labor. Banks aren't just judged on returns. They're judged on whether they finance projects that meet global climate goals. In other words, ESG isn't optional, it's existential. And if blockchain is truly going to integrate with global finance, it has to speak the ESG language fluently. That's why understanding why ESG is more than a fad, why it matters to financial markets, and why any blockchain that ignores it risks irrelevance. Hedera didn't just notice this trend, it architected its entire system to fit into it. And in the sections ahead, we'll break down exactly how. But before we move on, let's pause on the takeaway here. The ESG wave is massive, irreversible, and already reshaping finance. For blockchains, it's not enough to scale or be fast. They have to prove they're sustainable, transparent, and aligned with long-term governance standards. Hedera saw that early, and that foresight might just be the reason it becomes a long-term winner in this space. When you look at the blockchain landscape, one of the biggest criticisms people throw around is this: it's not sustainable. Whether it's headlines about Bitcoin consuming more electricity than some countries, or debates about Ethereum's energy use before the merge, the narrative has stuck. For many outside the crypto bubble, regulators, institutions, even retail investors, blockchain equals heavy carbon footprint. But Hedera was built to flip that narrative on its head. Unlike older blockchains that had to retrofit sustainability after facing criticism, Hedera engineered ESG principles into its DNA from day one. And that difference is a big deal in 2025. First, let's talk about energy efficiency. Hedera runs on the Hashgraph consensus algorithm, a system that doesn't rely on mining or wasteful proof-of-work puzzles. Instead, it uses a gossip about gossip protocol combined with virtual voting. What does that mean in plain English? It means transactions get validated quickly, securely, and without the insane power draw of traditional mining. Independent studies have shown that a Hedera transaction uses a fraction of the energy of even proof-of-stake networks. We're talking about the energy equivalent of a few Google searches, not powering an entire household for a week. That energy advantage directly ties into ESG. Institutions choosing a blockchain don't want headlines accusing them of destroying the planet just to run payments or tokenize assets. With Hedera, they can actually flip the story. They can say, look, we're using one of the most sustainable distributed networks out there. But Hedera didn't stop at being efficient. It went a step further and committed to being carbon negative. Through partnerships and offset programs, Hedera ensures that its network doesn't just neutralize emissions, it overcompensates. That's a rare claim in crypto, where many chains are still scrambling to reach neutrality. In an age where carbon accounting is becoming mandatory for big corporations, Hedera's proactive approach is music to the ears of compliance officers and ESG-focused investors. Now, let's compare Hedera with other blockchains. Bitcoin, for all its decentralization strengths, has been hammered for its energy consumption. Ethereum solved part of this problem by moving to proof-of-stake in 2022, slashing energy usage by more than 99%. That was a massive win for Ethereum's ESG story, but Hedera still stands apart. Why? Because it's not just about energy savings, it's about built-in sustainability governance. See, Hedera is governed by its governing council, which includes major corporations and institutions like Google, IBM, Standard Bank, Boeing, and others. These aren't just names on a list, they actively help shape the direction of the network. And because these are global enterprises already bound by ESG commitments, Hedera inherits that culture of accountability. Decisions about network upgrades, sustainability goals, and ecosystem development are made with ESG in mind. No other blockchain has governance tied so directly to real-world corporate ESG standards. Another factor worth highlighting is transparency. ESG isn't only about being green, it's also about being accountable. Hedera publishes sustainability reports, energy use data, and offset details. Compare that to Bitcoin, where most conversations around energy are fragmented estimates, or Ethereum, where metrics are debated across independent sources. Hedera brings corporate-grade reporting to blockchain, and that's exactly what regulators and institutional investors look for. And here's where things get interesting. Because Hedera was designed for sustainability from the start, it doesn't have to spin its ESG narrative, it lives it. That authenticity matters. A bank can tell its clients, we're tokenizing assets on Hedera, and point to real carbon numbers. A supply chain company can say, we're tracking sustainability with Hedera, and show measurable impact. In a world where greenwashing accusations are flying left and right, Hedera's numbers back up its story. Of course, ESG isn't only about the E. Governance is the G, and Hedera excels here too. The council model means it isn't run by a single foundation or anonymous miners. It's guided by a diverse set of global players with reputations to protect. That doesn't mean it's perfect. Critics argue it's less decentralized than proof-of-work chains, But from an ESG perspective, governance that aligns with real-world standards is a strength, not a weakness. So when you add it all up, energy efficiency, carbon negative status, transparent reporting, and enterprise-grade governance, you start to see why Hedera is uniquely positioned in the ESG conversation. While many blockchains are trying to prove they can be sustainable, Hedera is already there. It doesn't need to retrofit, rebrand, or scramble to meet new global standards. In fact, that's why so many ESG-focused projects have gravitated toward Hedera. From carbon credit marketplaces to sustainability tracking in supply chains, the network is a natural fit. It isn't just providing the rails, it's aligning directly with the values that define modern finance. Here's the takeaway. ESG isn't just another checkbox for Hedera. It's part of its competitive moat. When institutions compare options for tokenization, payments, or digital identity, Hedera can raise its hand and say, "We're fast, secure, scalable, and we're the most sustainable choice." That one line alone opens doors that other chains struggle to walk through. And as we move deeper into this decade, where every company will be measured not just on profits but also on purpose, Hedera's ESG-first architecture could be the secret weapon that helps it stand out, not just in crypto but in global finance. Alright, so we've talked about the theory, the ESG wave shaping finance, and why Hedera was built to fit right into that movement. But theory is one thing. What really matters is practice. What's actually happening on Hedera today that connects it to the real-world ESG conversation? The answer, quite a lot. Hedera isn't just claiming sustainability. It's powering live ESG projects across multiple industries. And these aren't just small startups experimenting in isolation. Many involve enterprises, NGOs, and global organizations who are testing how blockchain can bring transparency and accountability to sustainability. Let's break down a few of the most interesting use cases. Carbon credit marketplaces. One of the loudest criticisms of traditional carbon markets is that they're opaque, fragmented, and sometimes even fraudulent. Companies buy credits to offset emissions, but how do you really know the credits are valid? Are they double-counted? Do they represent actual carbon reduction? This is where Hedera has been making waves. Projects like Decarbon and the Guardian platform are using Hedera to create verifiable, tamper-proof records of carbon credits. Each credit can be represented as a token on the network, with transparent metadata about its origin, certification, and retirement status. That way, companies and regulators can track every step of the life cycle. The Guardian, in particular, is powerful because it's open source and modular. It allows carbon credit registries to plug into Hedera, ensuring that the underlying data, whether from a reforestation project or a renewable energy initiative, is anchored to an immutable, energy-efficient ledger. That level of transparency is exactly what ESG investors are demanding. Supply chain sustainability. Next up is supply chains. If you think about ESG, the supply chain is one of the biggest headaches for corporations. It's not enough to say we're carbon neutral if your suppliers are polluting or using unfair labor practices. Consumers and regulators now want proof that every link in the chain meets sustainability standards. On Hedera, projects are emerging that track and tokenize supply chain data. For example, agricultural companies can log product journeys from farm to shelf on Hedera. Each step records not only location but also emissions data, certifications, and labor compliance. That means a supermarket could one day scan a product and show customers. This was grown sustainably, transported efficiently, and verified on Hedera. It's not just food. In industries like fashion, where fast fashion's environmental toll has come under fire, tokenizing supply chain data could prove a brand's ESG commitments are more than marketing. Hedera's low-cost, energy-efficient design makes it feasible to log millions of small data points without breaking the bank. Tokenized renewable energy. Another ESG frontier is renewable energy tracking. Imagine solar panels or wind farms generating not just electricity, but also digital tokens representing units of clean energy. These tokens could then be sold, traded, or used by companies looking to meet renewable energy commitments. On Hedera, renewable energy producers are experimenting with exactly that. By anchoring data about energy production on Hedera, they can tokenize the output, creating transparent markets for renewable energy credits. This doesn't just help big corporations meet compliance. It also creates new revenue streams for green energy startups. NGOs and humanitarian use cases. It's not only corporations exploring Hedera's ESG capabilities. NGOs and humanitarian organizations are getting involved too. For instance, the United Nations has worked with Hedera in pilots around carbon accounting and climate action. The logic is simple. NGOs need cost-effective, transparent, and scalable tools to prove their impact. Hedera offers exactly that. Imagine a reforestation nonprofit being able to show donors, in real time, the exact carbon offsets created by their work, recorded immutably on Hedera. Or a climate resilience fund transparently distributing aid with every transaction traceable and carbon accounted for. This isn't sci-fi, it's pilots happening right now. Financial products with ESG at the core. Finally, there's the growing intersection of finance and ESG. Tokenization of assets is hot across crypto, but on Hedera, the unique selling point is ESG compliance baked in. Imagine tokenized green bonds, financial instruments that raise money specifically for sustainability projects, being issued and traded on Hedera. Because the network itself is carbon negative, and because it can tie bond reporting directly into ESG data feeds, investors get not only yield but verifiable impact. This could appeal to the $50 trillion in ESG-focused capital markets that are desperate for trustworthy, transparent instruments. And while Ethereum or Stellar can also host these assets, Hedera's entire brand as the ESG blockchain gives it a natural edge. Why these projects matter? Now, you might be asking, okay, these use cases sound good, but why do they matter in the big picture? Here's the key: institutional credibility. When big banks, corporations, or NGOs experiment with blockchain, they're not just looking for tech that works. They're looking for tech that aligns with their ESG mandates. Hedera's real-world ESG projects aren't isolated. They're proof points that the network can handle live, impactful use cases. Each successful pilot is one more reason for institutions to consider Hedera when they're deciding where to build their future digital infrastructure. And here's the kicker. Once those ESG rails are built on Hedera, they're sticky. A company tokenizing carbon credits or logging supply chain data isn't going to switch networks casually. That creates a moat for Hedera, one that's not just technological but also reputational. So, when we talk about HBAR being a secret weapon in ESG, it's not hypothetical. The projects are live. The pilots are happening. And the institutions experimenting with Hedera aren't doing it as a side hustle. They're testing how to future-proof their sustainability commitments. So, we've looked at the projects, the pilots, and the fact that Hedera is already being used for ESG-aligned applications. But the real question is this: how does that translate into a market advantage for HBAR? After all, it's one thing to say a network is green. It's another to prove that sustainability can actually be a wedge that helps it win adoption, capital, and investor trust. Institutional alignment. Institutions today are under massive pressure to meet ESG targets. Banks, corporations, and even governments are no longer free to ignore sustainability mandates. Every investment report, every new partnership, every tech integration is viewed through the ESG lens. Here's where Hedera stands out. Its carbon-negative ledger and verifiable ESG use cases give it a built-in alignment with those mandates. If a bank is exploring blockchain for carbon credit tokenization or green bond issuance, choosing Hedera means their choice itself supports their ESG narrative. That's a marketable advantage that Ethereum, still criticized for energy use, even post-merge or Bitcoin, often labeled an ESG liability, just can't replicate. Cost and efficiency edge. Let's not forget the economics. ESG aside, Hedera is cheap and fast. Transactions cost fractions of a cent and settle in seconds. For enterprises, that efficiency is attractive on its own. But when combined with the green angle, it's a 2-for-1 pitch. Save money and meet ESG targets simultaneously. That's a hard combo to beat. Competitive differentiation. Look at the competitive landscape. Stellar positions itself as the payments blockchain. Ethereum is the general-purpose smart contract giant. Solana sells speed. Hedera? It's carving out the ESG blockchain as its identity. That's smart positioning because while the other chains battle over DeFi and memecoins, Hedera is pitching itself to a market where trillions of dollars are at stake. The ESG-driven capital markets. Investor sentiment. Now, let's talk HBAR, the asset. Investors, especially institutional investors, want exposure to crypto that doesn't clash with ESG mandates. Some funds outright ban Bitcoin because of its energy footprint. That means HBAR has a narrative advantage. It's not just a utility token, it's a compliant, ESG-friendly investment story. When an ESG-focused ETF or green digital asset index is built, which coins are likely candidates? Bitcoin? Maybe not. Ethereum? Perhaps with caveats. HBAR? Absolutely, it fits the ESG narrative perfectly. That positioning could open doors for inflows once ESG-focused digital asset funds scale up. Long-term stickiness. Finally, sustainability isn't a passing fad. It's a structural shift in markets. ESG is projected to shape over $50 trillion in assets under management by 2030. That means Hedera isn't chasing a temporary narrative. It's aligning itself with one of the deepest, most durable currents in global finance. The projects being built today, carbon credit marketplaces, supply chain tracking, renewable energy tokenization, could be the rails for decades of ESG reporting and trading. In short, Hedera's green DNA doesn't just look good on a marketing deck. It could be the wedge that gets it chosen for high-value institutional use cases. And every time that happens, demand for HBAR, as the network's fuel, quietly grows. So here's the big picture. ESG isn't just a checkbox anymore. It's the playing field. Every major corporation, government, and financial institution is being forced to rethink how they report, operate, and invest. And in that world, Hedera isn't just another blockchain. It's positioned as the sustainability-first network that aligns perfectly with where the money is flowing. Think about it. The governing council is filled with Fortune 500s who already have ESG mandates to meet. The projects running on Hedera aren't speculative memes. They're carbon credit marketplaces, renewable energy tracking systems, and supply chain transparency platforms. These are real-world ESG solutions tied directly to trillion-dollar industries. For HBAR holders, that's not just hype. It's utility that translates into adoption, demand, and long-term relevance. While other chains fight over speed or hype cycles, Hedera is aligning itself with the deepest capital currents in global finance. So the question is, when ESG becomes the standard, which blockchain will institutions trust to power their solutions? My bet is that Hedera is building that moat right now. Stay tuned, because this could be the sustainability story that defines the next wave of crypto adoption.